Hey, one of the first rules when you're looking to invest in a new market is to understand and look for population growth. However, population growth is really overrated. And we get into that with today's guest, Mac Shelton. You see, Mac is located in Raleigh, North Carolina, one of the hottest markets, especially when it comes to population growth. However, he's investing in smaller markets in North Carolina and the Virginias. And the reason is this. He knows that population growth is just one metric. There's really something more important that we're looking at when it comes to finding the right markets to deliver great results for investors. So if you want to learn what you should be paying attention to when investing in markets, check out today's conversation right here on Multifamily Insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide. Go to our website, casmoncapital.com/7 questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you, though, we've put a link in our show notes. So you go to the show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. Mac Shelton is the co-founder of Sweetbay Capital, a real estate private equity firm focused on multifamily investments in Virginia and the Carolinas. He and his team have over 191 units under management. Let's welcome to the show, Mac Shelton.
Thanks for having me on.
Yeah, absolutely. Matt, great to have you. I went over your bio at a very, very high level. Why don't you take 2 minutes and fill in some of those gaps?
Sure. So I'll start by saying our portfolio now actually is 342 units across.
Well, that's a little bit more than 191.
Yeah, and we're looking outside of those states as well. We've only bought in those states so far, but we're also looking at some other contiguous states in the southeast. Really, as far as geographies go, one of the things that we focus a lot on is relative value and new supply. So, for example, we haven't bought anything in Raleigh or Charlotte. I live in Raleigh, right? I'd love to own something here, and pricing hasn't made sense here in a very long time. And we're actually getting better performance right now out of our smaller markets than we're seeing in the deals in markets like Raleigh, Charlotte, Greenville, South Carolina, that have been very hot for a while. And of course, we're seeing all the new supply everyone's been talking about for the last 2 or 3 years, right? And as a result, rents are going backwards in a lot of those markets, whereas we're growing year over year at almost all of our properties. So, but as far as just Sweetbay background overview, as you mentioned, we're focused on value add multifamily in the Southeast. I actually started my career on the corporate private equity side, so buying companies as opposed to real estate. I was also buying real estate on the side, and that's really what got me into this. We came across a deal in 2021 that was basically just an upsized version of 3 deals that I'd already done on my own that was a little too big for me. So we raised some money, and it ended up being a home run, and it kind of got us started. We've since been, continuing to try to grow the portfolio over the last few years and really settled into a value add focus.
Yeah, I appreciate that background. Just you talked about really your focus now over 340 units in kind of the Southeast region, Virginias, the Carolinas. You're in Raleigh, love Charlotte, but you're finding more success and better performance in deals that are, markets that are a little bit smaller. So that's kind of your focus today. And you got into the space really with the focus on investing in businesses. And then you've kind of transitioned into real estate when you found a deal that was too big for yourself. Let's talk about the markets first, and then I want to come back about kind of your origin or transition into multifamily. You mentioned that the smaller markets are giving you better performance, right? Let me say that again. You mentioned that the smaller markets are delivering better performance. How do you categorize that? Because I know that some folks love the major metros and they just say, hey, it's cyclical, it'll come back around. And others are looking for cash flow, more specifically. So
Yeah.
from your standpoint, as you think about better performance and what you're looking for in the market, How do you define that? What's your criteria?
So the simplest way to put it is that returns are not driven by population growth. They're driven by rent growth, which is driven by renter population growth relative to new supply growth, right? We've got most of our portfolio right now actually is in Roanoke, Virginia. We've got 216 units there. And we did an analysis a year or two ago looking at how rent growth diverged between the markets that were trading at, four caps when rates were six versus markets like Roanoke. And what we found, we averaged Roanoke and Columbia, which are two markets that we own in right now and that we've owned in previously, and that we categorize as sort of large tertiary, where you've got upwards of a quarter million people. There's a stable economy. There is population growth, even if it's relatively meager compared to some of the hotter markets. But we looked at average rent growth there versus the average of Raleigh, Richmond, Charlotte, Greenville, South Carolina, and Charleston, which are kind of the hottest five markets in our three states that we were focused on. And from 2020 to 2023, during the big COVID run up, the rent growth was almost identical. Actually, Roanoke and Columbia outperformed by about 50 basis points over that 3-year period. So at the same time, you could pay 59% less per dollar of rent to buy in Roanoke and Columbia, right? So you're paying less, you're getting the same rent growth. Everybody thinks that, oh, we can't possibly get the same rent growth because look at the population growth and the job growth into their markets, but you have to factor in new supply. And when you look at those markets now, it's actually, I mean, like I mentioned, right, we're having positive lease trade outs, especially Roanoke. We're growing 3 or 4% year over year there on lease trade outs, whereas most of the deals that we're seeing in Raleigh and Charlotte, as examples, rents are going backwards and there's concessions and you've got higher vacancy than you had a year ago because you're competing with brand new Class A product that's fully amenitized. And if if our tenants can afford that, they're going to go there over a smaller Class B property all day long, right?
Yeah, and Mac, real quick, I want to break down some of what you said because you gave some great information and great knowledge on your perspective, but also to make sure that we're able to process that. So you mentioned that when you looked at 2020 to 2023 in particular, you looked at some of these smaller markets like Roanoke, and you compare that to say Raleigh. You looked at it and said, you know what, the rent growth is similar, and I love what you said because you mentioned that population growth is a metric that most people focus and hone in on, right? And it's the first metric people tell you to look at when you're looking at markets. But you're saying it's not really about population growth. It's about rent growth. And rent growth has a couple of other factors you have to keep in mind, most notably new supply, which is the amount of new apartments coming into the area. And I love this because it's so easy to get caught up in numbers and metrics. And sometimes we can end up paying attention to the wrong ones and not really understand the full picture. And if you strip away all the technical stuff and the industry stuff, the only thing we're trying to understand is demand. Will demand drive rents to go up? Will they stay stagnant or will they decrease? And you have a lot of different factors and inputs that are going to help you get to a conclusion, but it's about rent growth, not necessarily population growth. Great that more people are moving to an area does not mean you're going to be able to charge more in rent. So you've got to ask the right questions and do the right digging on your numbers and your financials. You started to get into some of the metrics that you looked at. You talked about lease trade outs. You talked about concessions. You talked about kind of the vacancy and fully amenitized. That may be, a lot for folks who aren't as deep as operators. Break all that down for me. When you look at lease trade outs in particular, what does that mean to you? And how is that important as you're looking at deals in your portfolio?
So there's really two categories, I guess, when I think of lease trade outs. I'm not sure if this is the Webster definition, but basically there's, okay, someone moved out, I replaced them with a new tenant. How much higher or lower is the new tenant's rent versus the prior tenant's rent, right? And then you've also got renewals, and we've actually seen probably at least as much. Well, it depends, right? Because when we do a new lease to a new tenant, the unit that we're renting to the new tenant is not the same unit that the prior tenant had most of the time, right? Because we're typically renovating those units. I mean, we do have turnover in renovated units, but given sort of where we are in the hold period of our deals, most of them still have, we all have, still have legacy units that haven't been renovated yet. So usually when we're trading people out, it's into a renovated unit that's going to have higher rents, even if everything else was the same, right? But the renewals are maybe even a better gauge of true market demand, or at least market rent growth, because we're not upgrading those units typically, or maybe we'll put a new appliances or something if they request it. But for the most part, they're just signing a new lease for the same unit. And if you're able to increase rents, 3-4% that way, um, it's a lot cheaper for one than renovating. And so anyway, that's kind of what I'm talking about, is when we say these trade outs, is the difference between the new lease rent and the old lease rent, whether it's a new tenant or a renewal.
Yeah, and listen, it's a great metric, and it's something that we didn't really start learning about until we got into the operations side, right? I didn't go listen to podcasts and hear people talk about lease trade outs and things like this. So it's an important metric. And what you're getting at is you want to understand kind of the organic lift driven by the market, right? So if you turn over a unit, how much more money can you get? And a lot of times this factors into the business plan. If you're not going to get a large increase in rents, does it even make sense to go and renovate the unit, right? Maybe you just want to keep that existing tenant there because you're going to have some turnover costs either way. But this gets into the business plan, and whether you're active or you're passive, these are the kind of things you need to be asking and paying attention to when you're looking to invest in a deal. What is the business plan? What's the strategy? And can you pivot? Does the market allow you to pivot? I think people got caught up because they would come in and say, hey, we're going to renovate all the units. We're going to put $5,000 or $10,000 into the renovations. We're going to increase rents $200 or $300. And that's the plan. And when they got into it, well, maybe you couldn't increase rents because there was more competition. And now what do you do? How do you pivot? How do you adjust? These are the kind of things that newer operators, newer investors weren't aware of. And that's part of the reason you see some folks who are having deals that are challenged in this market. And savvy investors, savvy operators, they kind of always have a plan B, a plan C, and are able to adjust based on the feedback from the market. Going back to the markets that you're in, you talked about kind of these smaller adjacent markets to these larger metros. How do you see that playing out as you look at the data with lease trade-offs, with concessions, and some of the things happening? What is the story and the narrative that you see happening in these markets?
I think it's less to do with the size of the market. I mean, that has something to do with it, certainly, but it's more to do with how how flush that market has gotten with capital in the last few years, right? So, Raleigh is a great example. I grew up here. We've been growing, stably and pretty quickly since I was born, right in the '90s. And I mean, it's always been a pretty reliable growth market. I think this cycle, it's going to get hit harder than it ever has before, because it's the first cycle where it was sort of on the radar during the run up of the bigger developers that weren't just local developers, right? There's money from out of state coming in buying properties. And as a result, the run up was higher than it was, say prior to the Great Recession. And I think, the contraction is probably going to be more severe as a result, right? Um, we like to look for markets that are more like maybe Raleigh was in early 2000s, right? When it wasn't on the radar of these bigger funds. And you still have the fluctuations that the entire market experiences when rates change and values go up and down, but it's less severe in markets where there's not as much outside capital. Roanoke's a great example. I mean, there are a handful of groups that are sort of, institutional, if you want to call them that own there and buy there more now than there were 2 or 3 years ago. We started buying there, but it's still a market that a lot of people have never heard of, and it's not big enough for the kind of groups that are buying in Charlotte and Charleston to really be interested for the most part, right? So, you can still buy deals that would cost 125 a door in Raleigh, or even in some cases even in Greensboro, right? For 80, 85 door, In some cases even less. So that's sort of our strategy around those sorts of markets. It's not necessarily adjacent either, because like we've looked at plenty of deals around Raleigh and markets like Garner and well, even not even further out. And I'm sure I don't know how many of your listeners are familiar with this area, but Smithfield, Wendell, these are probably 30 minutes to an hour outside of Raleigh. Nobody's commuting. Well, a few people are, but very few people are commuting from these places into Raleigh, which is the story that I think brokers try to sell out of state money, right? And even those markets have gotten ridiculously expensive because they're in the Raleigh MSA, even if I'm not even sure they actually are, right? They're classified that way. And so it's not really about market size so much as just, is it a market that's sort of on the radar or not for the groups that they're paying, top dollar. And
Yeah.
there's risk to not being in that category, right? I mean, we've got a deal in Winston-Salem that will probably trade. We're getting ready to potentially sell it, and it's probably going to trade at a lower cap rate than anything else in our portfolio when we go to sell, just because it's in North Carolina, right? It's a '70s deal. Winston-Salem is not Raleigh, but it's North Carolina, and there are enough people out there that just see North Carolina and underwrite lower cap rates that will probably trade tighter than most of our other properties.
Yeah, Mac, that's the great insight. I was going to follow up with that, right? So what you're getting at is from the cash flow standpoint, the performance, you're able to find deals where from a market to market perspective, the growth rate is actually comparable to some of these larger metros that people are aware of. But when you look at the cost basis or what you can buy on a, dollar per dollar perspective, you're able to go in and buy stuff for maybe 80,000 a door. But if that was in, Winston-Salem or Raleigh, you might be looking at 100, 125, $150,000 a door. So you're coming in and getting great value based on the market and being able to still drive that cash flow and the business plan. However, on the flip side of that, the trade-off is there's a little less demand from other buyers because not as many people are going to be looking in these smaller markets. How do you weigh that with your investing thesis, right? Because obviously, for any investor who is looking to sell, I mean, if you're a buy and hold investment, you live in that market and you plan to hold it forever, great. It doesn't matter probably to you. But for those of you who have investors and you are looking to have an exit, that does start to factor into the exit projections. How do you kind of marry that concept, given that you're in a smaller, less known markets?
Ultimately, it comes down to the exit value or underwriting, which I mean, the way we do that is exit NOI divided by exit cap rate, right? And you need to, when you're doing that underwriting, really think and sanity check, does this make sense for the next buyer? We have a tab in our model that basically re-underwrites the deal from the buyer's perspective at exit. And yeah, we're not underwriting to the returns that we're underwriting in acquisition, because if we did, we'd never buy anything. But we're underwriting to returns that seem reasonable enough, right? That, I mean, double digit IRRs, at least mid single digits cash yields, reasonable enough that someone's likely going to want to buy that unless rates, go way up or something else changes, right? Um, and we're underwriting lower cap rates for deals in, for example, Raleigh than we are in Roanoke. I mean, good bit lower, right? But it's just factoring that in to your underwriting, and also looking into what things are traded before. I mean, we've got most of our deals in Roanoke. We've underwritten selling somewhere north of 120 a door, right? And there have been some trades in that range recently of renovated product like what we'll be selling when we're ready to exit. Same thing in Winston Salem. We before we bought our property in Winston Salem, we looked at sales comps, and there was one a couple miles away that's '70s product like ours, smaller units, lower rents, and it sold. I think mostly renovated. I don't know exactly if they were all renovated, but it sold for more than we were underwriting selling for. And, that gave us a little bit of comfort that, okay, if something just sold 6 months ago for 121 a door, we'd be able to get 115 in 5 years, for a arguably better product.
Yeah, Matt, what you're getting at is really just making sure you do your due diligence and validate your exit assumptions, right? Checking out the comps. What are they selling for? What kind of product or finish do they have? not just looking at NOI and cap rate, but also looking on a price per door basis, right? Like it's very easy to
Sure.
get caught up in one single metric. But oh, look, it's this cap rate or is that. But you've got to look at the whole picture as we talked about earlier, right? And
Sure.
understanding the whole picture, that gives you some confidence to say, I feel like we're being pretty conservative. We got a couple of checks in here to make sure that we have options. And that's going to give us that confidence to move forward on the deal and this business plan. Let's flip back. I want to talk about how you got into this space because you mentioned you were focused on businesses before really getting into the real estate. Talk to us about kind of that transition in your background in the business space.
Sure. So, I mean, I started out pretty briefly on the private debt side of things. I was working at a shop that did primarily mezzanine lending, subordinated debt and some equity investments in typically private equity backed deals. That company sold a year after I started. They laid off the whole investment team. So I moved to a private equity firm out in San Francisco for a few years. And we bought everything from software to healthcare, consumer, business services. It was basically everything but oil and gas and real estate. And that experience, well, then after that, I spent a couple of years at a healthcare based private equity firm here in Raleigh. That experience definitely helped a lot on the just how to think through deals piece of what I do now, and certainly the underwriting. Going through reps of just running a due diligence process, winding up your financing, keeping track of all the things that have to happen in order to close a deal, right, and raising money. I was involved in a lot of sort of third party equity raises where we'd have a fund, but the deal was too big for us to write just out of the fund. So we'd sell down some equity to outside groups. Um, and so all that experience was very valuable for the numbers piece of what I'm doing now. Because at the end of the day, both jobs were, you know, buying leveraged investments, right? Buying assets that generate cash and using debt to do it. The the transition really came down to, I mean, I started buying rental properties in 2017. I was at a point where basically I just put my bonus every year into another rental property. And the first deal that I raised money for was, I mentioned earlier, just an upsize of a deal I'd already done. I'd bought three student rental properties in Columbia, South Carolina, and our first syndication was an 11 property portfolio in the same development. So it was pretty easy to say, okay, I've got, at that point, I think I had about 2.5 years worth of financials. And, I could look back and say, okay, well, here's what I underwrote, here's what happened. I can underwrite sort of the same thing going forward. And it was an off market deal. We bought it straight from a developer. We got a great price. So it was a pretty simple deal to sell to investors. We also didn't raise that much. I think it was like $300,000 that we raised. But that got us started because I didn't know if I could raise 300 grand at the time. We probably could have raised 2 million if we needed it. We just didn't know until we tried. So that was a good impetus to start looking at bigger deals. But that's sort of how I got into it.
Yeah, I think the insight there is right. Just get started. Put yourself in a
Yeah.
situation where you do need help and you need to take on a challenge, and have a challenge that's not so insurmountable that maybe it defeats the confidence. But with your background, you were around this space. You're around private equity. You're around raising capital for deals. So that was familiar to you. You just hadn't done it yourself. And raising $300,000, like you said, you had the conversations, you got the investors lined up, and that allowed you to build some confidence to say, what, I think we can go after bigger deals. How did
Mhm.
you structure that? Was that a JV deal? Was that a syndication? Like, how did you
It was
structure that?
syndication. Most of our deals so far have been syndications.
Okay, so that's a syndication on 300,000 out of your first deal. How did you kind of scale and build what ultimately becomes Sweetbay?
So the first one, I think we sent it to 50 or so investors. And like I said, we had interest. I mean, it was at least 1 million of interest. It might have been two. It's been a while now, so I don't exactly remember. But it was enough that I was like, okay, we ought to be able to raise up to 2 million of equity for a bigger deal, especially if we go broader, which we did, right? We went from that 50 to we probably sent that second deal to 500 investors, right? And we also 1031 the proceeds from the first deal into the second, which gave us about 600,000 of equity we didn't have to go raise again. So that certainly made it easier, right? And then that second deal, which was our first in Roanoke. It was two properties, one that we sold last year, one we cashed out, refi this year. Um, that was the one that afterwards we went full time with it, right? And I think that also helped raise money for the next deal because now it's your full time focus. You got some experience, you got a track record. Our first deal was a 76% IRR, which didn't hurt fundraising. So I think, yeah, I mean, it was scaling up that way. And honestly, if you can start at a level that you're comfortable with in terms of fundraising, the best way to grow your equity base is to actually grow your equity base, give the money back to your investors at a 2x and then invest it again, right? Like if you can just keep doing that, I know a lot of guys that have, it takes longer than some people want to wait, but I know a lot of guys that have done that over, decades. And what started with 300 grand is now 10, $15 million because they just kept rolling that into more deals. And for the most part, if somebody's giving you money, especially for your first or second syndication, they shouldn't be giving you money that they really ever need again, right? They're giving you money that's going to be either with you or in some investment account. It's probably never going to be, you know, spent until they're retired at least, right? So they're probably going to reinvest when you return that capital at the end of your deal.
Yeah, Mac, the thing that stands out to me is just the patience in the approach. And you start to get at this, but that first deal, you raised the money, you were aware that you probably could have raised more, but you kind of waited until you execute it. And then you kind of 1031 some of those investors into the second deal and also raise more money for that second deal. And to your point, that snowball effect, that's a great way starting out because now you've got proof. Those investors, they believe in you because you've done it. You've
Yep.
delivered, right? You've executed on the business plan. So it's no longer about trying to sell yourself and get them excited about the visions like they've seen you execute the vision. So it's way easier to keep an investor, once you've executed for them than to go and find a new investor. Can you just talk a little bit more about kind of how you manage investor relations and keeping those investors happy?
Yeah. So we definitely grown the investor base a lot over the years. Yeah, how many of I mean, to put that in perspective, I think I said that first deal was less than 100 people that got the deck. We've now got about 2,500 people in the investor database. That being said, only about 1,000 of them probably even open the email, and only about 500 of those actually read it, right? But it's more exposure, and we've had word of mouth introductions to new investors from our existing LPs. As far as just investor relations, I think, well, the way we do it, we do quarterly updates on each deal. We do a quarterly newsletter, and I think the two things that our investors would say separate our communications from some of the other groups that they, may have seen deals from. For one, it starts with our offering memos on new deals, right? We're not sending out a 5-page summary that's got 1 page of financials, 3 pictures of the skyline, and a partner bio. It's 30, 40 pages of detailed analysis around our business plan, what our target rents are going to be, what we're going to spend on renovations, a detailed budget that's been checked against hard quotes for all of CapEx, right? Um, and really laying out, okay, this is exactly what we're going to do, and here are the rent comps and the sales comps to justify why we think it's doable. Um, and also laying out the one of the really important things that it shocks me how many people don't do this is laying out the GP economics and the fees and the promotes you're going to charge completely transparently. I mean, yeah, I've seen deals where the closing costs is a lot bigger than it should be, and there's no acquisition fee listed. And it's like, come on, right? Just be transparent with your investors. And the other thing is our quarterly updates. So that goes hand in hand with the transparency I mentioned, right? It's when things are going great, it's great. We always try to find something. We almost look for something negative to say in every review, even when things are going great, just to sort of balance things. And when things aren't going great, like we've missed budget on a deal before, right? On certain quarters, and like we explain why and what we're going to do to fix it. And we compare our performance every quarter to the projections that were in the deck that convinced the investor to wire the money in the first place, right? And we don't change those budgets a year or two later because the market changed. It's okay. Here's where we're at relative to what we underwrote. And I think investors really appreciate that transparency.
Yeah, great stuff, Mac. I mean, you talked about really just a couple things. First and foremost, understanding the business plan when you're talking to folks, you're emailing them the deals, you're communicating quarterly with them, but you're also when you have a deal, that offering memorandum, you're giving them a great executive summary. You're getting into the budget, you're getting into the projections, you're getting into really validating and supporting what you see. And I think that's so important because as you mentioned, when someone sees that deal in the offering memorandum or whatever you put in front of them, that's what they have to go off of. And they don't know how, detailed or diligent you've been in that process. So you kind of have to verify that and show your work, right? It's like a
Mhm.
math problem. You got to show your work. Here's how I got to these figures, right? I didn't just pull up a number and say, hey, let's get to a 15 IRR. You want to show them, hey, here's what we see in the market. Here's what we think. And we're going to just verify that and go out there. Obviously, things change when you go to execute. But on the same note, for investors, they want to know, hey, you at least understood what the market was. You had a clear vision of how to go out there and execute, and you can pivot if and when necessary. Real good stuff there, man. For someone who was maybe in your shoes, around the time of that first deal, looking back, what advice would you give them to build a successful real estate syndication business?
I mean, I think it starts with doing your own deals. I have no idea if we would have been able to raise money for the first one if we hadn't already done it, you know? And frankly, I don't really think people should do it that way unless they've done it themselves. Yeah, I mean, I think that's the number one thing is start with deals you can do yourself. And it's harder now than it was when I started because, in my first deal, I think I put 30 grand down. My rate was, 3.5%. Right. You can't do that anymore. But you got to start with your own money or start with if you've got, maybe one investor that, is a close friend or whatever, right? Or mentor, but, or is going to be an active partner in the deal. But I would not recommend anybody go out and try to syndicate their first deal solo without ever buying real estate before, Um, so that's number one. And that's how we built it was just gradually, like I said, I bought four rental properties over 4 years before the first syndication. Um, and hand in hand with that, I mean, I didn't quit my job until the second syndication, right? In the first exit, which I think was honestly, sometimes I wish I'd waited longer to quit my job. But certainly glad I didn't do it after that first syndication, right? We also didn't charge any promote on the first deal, which I think definitely helped with the fundraise. I kind of regret that in hindsight a little bit given the returns, but it wasn't that big of a deal anyway. So that's something to keep in mind is, when you're trying to raise money, assuming you're talking to the kind of people that can actually fund your deal, you're not the only sponsor that they're talking to. And you've got to provide something to differentiate yourself. If you don't have any experience or you don't have, you know, good, solid experience that's relevant to what you're doing, it's like anything else, right? If you're not offering the best product, it better be the cheapest product, right? So that's how we raised money for the first deal. Was we charged a 3% acquisition fee, and that was it. Um, and I think that made it a lot easier to raise money if we tried to go do a 20% promote or something like that.
Yeah, good stuff, Mac. I appreciate that, man. For listeners who want to learn more, what's the best way for them to reach out?
You can find me on LinkedIn, and you can visit our website. It's www.sweetbay-capital.com.
Appreciate that.
My
All right.
contact goes all on the website.
Check that out, sweetbay-capital.com. Mac, we're going to transition and go to our round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmoncapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmoncapital.com and click on the mastermind button today.
Okay.
Give me a failure or an apparent failure that sets you up for later success.
I think one one example from our portfolio, one of our deals, let me sort of frame it. Two different deals. The first deal in Roanoke, or second deal, right? We started our renovations with the mindset of we're going to do the bare minimum and see what we can get on rents, and that's going to guide the rest of our renovation plan throughout the whole period. Another deal, we had a little bit tighter timeline because we've got an assumable loan that goes floating rate into next year, and so we sort of were like, we need to kind of move through these renovations, and we just sort of went all in on the first handful of renovations to push rents as high as we can get them, and kind of figure out as quickly as we could whether it was worth doing that or not. The former was a much better approach. We're way over budget on renovations on the second deal now, and a lot of it is because there was just stuff behind the walls we couldn't find, right? But a lot of it also is because we didn't take that measured approach of, like you mentioned earlier, right? People saying, "Oh, I'm going to spend X amount and push rents X amount." I found in most cases, the rent premiums that people underwrite and have been marketed, most of that wasn't renovation premium. Even back in like 2021, 2022, it was billed as renovation premium, but in a lot of cases, it was just rent growth. Because at the end of the day, especially in like C+, B- properties, tenants aren't going to pay 20% more because they have like a nicer linoleum countertop than the one they had previously, right? Or because they're just not. So anyway, that's a learning is, don't start with sort of trying to test out what you really need to spend on units in order to get the rents you underwrote. Don't just go all out, especially like early on in your early deals, right? Don't just go all out on the first few renovations, and because you probably don't need to, and you probably underwrote more rent premium than you're actually going to get from renovations.
Give me a digital or mobile resource you recommend for our listeners.
One thing I got about a year ago that I've gotten some value out of, it's an app called Landglide. I think it's like maybe $100 a year. It's I'm sure anybody that's invested in real estate has been on the county tax assessor's website and dug through. They're all different formats. Some of them are great, some of them are terrible, to try to find owner information and sale info, that kind of stuff. This is basically a consolidated GIS for, I believe, the whole country. And I mean, there are other services that I'm sure are better that do the same thing, but they're a lot more expensive than $100 a year. So I can, really quickly just pull up my app on my phone and click on a parcel and at least see who the owner is, and sometimes when it traded last, So that's I think worthwhile for a lot of people.
And that's Landglide?
Yeah, Landglide.
All right, check that out. Give me the book you recommended or gifted the most in the last year.
One that's relevant for this conversation that I got a lot of use out of was, and I don't know if I've recommended much in the last year, but I wish the name was better because I don't know. Anyway, it's The Best Ever Real Estate. So, one of Joe Fairless's books, but it's the one on multifamily syndication. And he does a great job of laying it out step by step of, how do you make this business work? How do you select markets? How do you underwrite deals? What sort of market, GP economics? Some of it is probably a little outdated because it's, I think, 2015 or 16, but it's, for the most part, it's relevant today, And it was really part of when we first started mapping out, okay, what's this business going to look like? I mean, that was a big part of how we got started. So that's a good one.
Yeah, great book there. Best Ever Apartment Syndication book. Joe Fairless, Theo Hicks, great book. I'll make sure we link to that in the show notes there. All right, give us a daily habit that helps you stay focused on your goals.
Biggest thing for me is just getting up in the morning and doing some form of exercise. I find that my days are completely different when I do that. I don't. Whether it's going for a run, going to the gym, even just taking the dog for a walk. Like when I get up early and do something active, the rest of my day is 100% better and more focused than it would be otherwise.
Love it. Definitely want to do that. Give me your number one insight for finding great markets.
Man, I don't know that I have one, but I think it's, I'd say don't get too sucked in by the hype around markets and really look at the fundamentals, right? Really look at, okay, what are things trading for? What are the rents? How many deals are left that, haven't already been picked over by people trying to do the exact same thing that I'm trying to do, right? But yeah, I mean, looking at the fundamentals, doing analysis like the one I mentioned earlier, where you actually compare the rent growth of markets that people would assume at face value didn't grow as much as Raleigh or Charlotte, and seeing that they actually do the same, right? Do that kind of analysis, really dig into the data, don't be swayed by noise and what people are talking about on the internet.
All right, you are in Raleigh. Give us your favorite place. Let's say it again. Give us your favorite place to grab a bite to eat.
I'm gonna do two, because it depends on the mood you're in and your budget. So my favorite, just sort of quick spot, is probably Mojo's. I think it's Mojo's Burger Joint is what it's called. It's on Glenwood. It's best cheeseburger in Raleigh. And then if you're going to a nice dinner, it's the Stanbury for sure. It's like a American. They've got like a little bit of a Cajun thing going on, but it's really just sort of American tapas kind of stuff. And it's excellent.
All right, two good options right there. Appreciate it. Matt, lots of great information, man. I really enjoyed hearing more about your story and your journey. Really starting off small, right? Getting that first deal, you had those houses that you had invested in yourself, but raised around 300,000 for that first syndication. Now you got over 340 units in a portfolio. It's talking about just the way you focus on markets, not necessarily going to the Charlottes and the Raleighs. Not that you wouldn't, just you're finding more value in some of these smaller markets and recognizing that, hey, these markets are growing from a population standpoint at a similar rate, but the rent growth in some of these smaller markets, it eclipses what we're seeing in the larger markets, primarily due to new supply that's coming online. It's just a great reminder that our job as investors is to focus on creating value, not necessarily just chasing trends. So keep that in mind as you're running your business plan. Understand what work is necessary for the projects that you're investing in, and always do your due diligence. Again, if those of you who want to find more about Mac and his team, be sure to check out sweetbay-capital.com. Mac, thanks again for being a great guest and coming on the show. We look forward to staying in touch with you, and I hope you have a great day.